Yes, I think that there's a lot more tailwinds building for markets in 2025 than have existed in 2024.
The year 2024 has brought new highs and lows for investors, creating the perfect roller coaster of sentiments around the market. In the build up to elections and even after the elections, some markets experienced sky-high growths. Case in point, Bitcoin and other cryptocurrencies, MicroStrategy, and even exchanges like Coinbase. However, for all the wins, the market is also riddled with substantial losses. With the year rapidly winding down with only a few days to go, it begs the question, what can we expect in the market going into 2025? Before we explore this question further, please like, subscribe, and turn on notifications to keep up with Bitcoin's rising journey. That said, back to the video.
Yes, I think that there's a lot more tailwinds building for markets in 2025 than have existed in 2024, mainly because, now we're not worrying about the Fed, worrying about inflation and bringing a halt to the economy. We have an election that's behind us, and now we have a lot of cash on the sidelines, and I think companies finally having more courage and what I think we'd call animal spirits and a willingness to start to do mergers and other things that, like capital markets, that actually help stocks next year.
Respondents to a CNBC survey predict more gains for big cap stocks going into 2025. Tom Lee, better known as the managing partner and co-founder of Fundstrat, echoes sentiments similar to those of respondents. According to the veteran investor, the current macroeconomics of the nation and the market at large make for sustainable market dynamics that suggest favorable outcomes for stock market rallies next year. In his words, I think there are a lot more tailwinds building up for markets in 2025 than have existed in 2024, mainly because we're not worrying about the Fed, inflation, and bringing a halt to the economy. We have an election that's behind us, and now we have a lot of cash on the sidelines. I think companies finally having more courage, what we call animal spirits, and a willingness to start doing mergers and other things like capital markets that help stocks next year. Let's break this down. Lee's sentiments are part of a broader market report published by his company for the 2025 fiscal year. The veteran investor, mostly bullish on the S&P 500, sees these supported tailwinds as the outcome of the past 2 years. For starters, according to his projections, the S&P 500 rising by 8% isn't unusual for its historical yearly returns from the market. The incumbent federal and incoming governments support this projection. The current federal situation refers to the Federal Reserve cutting interest rates and adhering to the labor part of its mandate, a move that will improve investor participation in the market. Of course, this outcome is only possible if inflation is kept minimal. On the other hand, the incoming Trump administration, with its pro-crypto stance, lower tax cuts, and business-friendly policies, would encourage corporate sentiments and improve profitability. Lee's third projection suggests a boom in acquisitions and mergers, which isn't far-fetched should business sentiments improve under Trump. Altogether, these factors will encourage investors to lean more towards equity and away from bonds and cash, which is great news for stock prices. Tom Lee is an authority figure in the market analysis, because his previous predictions in 2023 and 2024 were right on the money. He nailed the 2023 finish of the S&P 500, and his 2024 predictions came very close to reality, especially as he exposed caution in September and increased his end-year forecast to 6,000 in October.
Do you worry? I mean, we showed some of these gains, Tom. Listen, you're Tom Lee, you don't worry about a whole lot of things. But I would say when we're looking at stocks that are up 550% and 300%, okay, there are paradigm shifts which will bring in a lot of money to new things. Is there any part of Tom Lee, not the drummer, that does worry that things are a little bit hot at 40 times forward earnings on many of these, like an Oracle, a name that we didn't talk about much for years?
I mean, at some point, valuation becomes a liability when the market isn't able to be surprised or the market has overpaid for future growth. But to me, the last couple of years is really a story where investors have been underpaying for technology and the amount of innovation. I think 2025 is a year where we're going to find the AI and a lot of these applications actually do sort of re-architect the way America does business, and it's vastly cheaper, and that's why these companies are doing so well. But you're right, Brian. At some point, it's a bubble. I don't really think that that's the word yet, because I don't find that much ebullience in our clients. I think our clients are still pretty skeptical about valuations, which is why I think valuations aren't really a problem just yet.
Although it's easy to get swept up in Lee's optimism, it also helps to acknowledge the possibility that things might go awry, with some companies, even the most unusual ones, ranking in as high as 40% forward earnings. Shouldn't that be a sign of things to come, and not in a good way? Lee answered this question with the same bullishness he's known for on Wall Street. According to him, valuations can be problematic, especially when the market is averse to surprises or overplays its hands in future growth. But Lee doesn't feel that the current state of things. He believes the market is underpaid for the sheer volume and quality of innovation and technology that has been churned out for years. Lee believes that 2025 is a year when all of that undervaluing will give way to proper valuation, especially with AI and other solutions. These solutions will change the architecture of how the nation does business, making things more affordable and proving why it's doing so well in the first place. Despite this sentiment, the Fundstrat co-founder isn't naive enough to believe this market state to be permanent. In fact, he describes it as a bubble, but not an established one, at least not at this moment, when valuations aren't yet problematic and investors are still skeptical about current valuations. The 2008 bubble burst more than showed the problems of valuations exceeding reality, so Lee isn't far off believing that the market isn't quite at that level of delusion yet.
One point I'll just raise on the skeptical note, which is on the call for small caps, Tom, which a lot of people were on the small cap bandwagon this year, and there were times where that really worked, but I don't know if December's a preview of what's to come. Small caps are still down 7% in December as the S&P's gone flat. NASDAQ far outperforming on the year, the small caps. Everyone hoped this was the time where the rally would broaden out, but then when the Fed pared back how many rate cuts it was going to get next year, small caps didn't work. So what makes you think that this will be the year?
Well, that's a really fair observation, Sarah. Small caps really are probably the best expression of when they believe the Fed is cutting for the right reasons, and there was a rug pull in December. I do think your viewers have to keep in mind small caps may not have hit escape velocity yet, but their underperformance for the last decade is 91 percentage points versus the S&P. It's the second worst 10-year underperformance since 1998. And then before
that's
that,
not necessarily bullish. I mean,
well, actually,
it
is very bullish,
right?
Sarah. It's super bullish because if you go back to 1900 and use FAMA data, it's the second worst in history. If you take the three worst instances, never have small caps underperformed the next 3 years or 5 years. So what we've done is essentially discounted so much bad news. There's so much skepticism. I think almost everybody that talks about small caps says, well, they haven't worked, so they're not going to work. They're trading at a 10 forward PE. They're going to benefit from deregulation. 49% of small caps are cyclical stocks, which are really primed to do well next year. So I think that the probabilities for a very good year are high at a time when skepticism's high. I mean, isn't that what FANG was at the start of 2023? I remembered how many people said, put a fork in FANG at the end of 2022, they're done. And they just put in the two best years I think anyone could have ever expected.
Finally, Lee has been a huge fan of small caps. Although the section of the market had its highs in 2024, the December run hasn't been exactly kind. With small caps down 7% this month, the S&P flattening and the NASDAQ 100 outperforming the small caps market, should investors who join the bandwagon be worried that this is a preview of things to come. The federal rate cuts haven't helped small caps either, but Lee believes that this move rug-pulled small caps. Even then, he remains bullish, believing that the underperformance of small caps compared to the S&P 500 in the last decade is the second worst performance in history. Mind you, bodes well for 2025. Lee states that deregulation, rate cuts, cyclical stocks which make up the small cap markets, and the high level of skepticism towards this part of the market are what will make small caps his escape velocity next year. Only time will tell if this prediction ages well. So what do you think? Let us know in the comments section. Also, like this video, subscribe to the channel, and turn on post notifications for more videos like this. Finally, don't hesitate to leave your views in the comments.